Okay, let's talk about finance. And hey, wait, don't click away. I know, the word itself can sound super intimidating. But honestly, it's really just about one thing: how to get the money you need to do the things you want. And believe it or not, it all comes down to a single, really universal question.
I mean, of course you have, right? We all have. It's that gap between what you want and what you can actually get. And that feeling, that's the engine that drives the entire world of finance. Seriously, from buying a simple pizza to building a billion-dollar factory.
Okay, so let's make this super real. Picture this. You're starving, you see the perfect pizza, it's 20 bucks. You check your pocket, and you've only got 10. Bummer. Well, that simple pizza problem, that is the key. It's the key to understanding pretty much everything in finance. So what's the move? What do you do? And this isn't just about getting dinner, right? It's about figuring out how to close that gap. The way you solve this little problem, it actually reveals the two fundamental pillars of the entire financial system. Yeah, that's right. The logic you'd use to get that extra 10 bucks for a pizza is the exact same logic a giant corporation uses to raise billions of dollars for a new factory. It's crazy, but it's true. So, how do you do it? Well, you've basically got two options. You can either split the cost with someone, or you can borrow the money. And each choice leads you down a totally different path with its own rules and consequences. Let's break them down. Okay, first up, equity. This is where you go to your friend and you say, hey, you put in 10 bucks, I'll put in my 10 bucks, and we'll just split the pizza. And boom, problem solved. You've got your $20. But what's the catch? Well, the catch is you've just given up ownership. You only get half the pizza now because you basically sold the other half to get the cash you needed. All right, then there's option two, debt. Let's say you want that whole pizza for yourself. So you turn to your friend and say, hey, can I borrow 10 bucks? I swear I'll pay you back. Now you get the entire pizza, all yours. But, and this is a big but, you now have an obligation. You owe that $10 back. And it doesn't matter if the pizza was amazing or if you tripped and dropped it on the ground, that debt has to be repaid, period. And this right here is where it all connects to the real world. Selling a piece of your pizza, that's equity, right? Well, that's what companies do when they issue stocks. They're selling tiny little slices of ownership. And borrowing money for the whole pizza, that's debt. In the big leagues, that's called issuing bonds, which are basically just fancy IOUs. So a shared pizza is like a stock, and a whole pizza you owe money on is like a bond. It's the exact same choice, just, on a much, much bigger scale. Okay, so up until now, we've only looked at this from your side of the table. You're the one who needs the money. But we've got to flip the script here. We have to ask the other really important question. Why is your friend even giving you the 10 bucks in the first place? Look, they're not just being nice. I mean, maybe your friend is, but in the financial world, the person who provides the money is called an investor. And whether they're buying a piece of your pizza or just lending you the cash, they expect to get something back for it. And that something has a name. It's called a return. Think of it like the universal yardstick for every single investment out there. It's how investors keep score. They're all asking the same simple question. Based on the money I put in, how much more am I going to have at the end of the year? And you'll see this number everywhere, usually as a percentage. So what does a return of, let's say, 8%? What does that actually mean for the person putting up the money? It's actually pretty simple. If you invest $100 and you get an 8% return, then a year later, you'll have $108. That extra 8 bucks, that's your profit. It's your reward for making the investment. But, and you knew there was a but coming, that reward doesn't come for free. It always comes with a trade-off. And that very trade-off brings us to the final, and I'd argue the most important rule in all of finance. This is the one principle that governs literally every single investment decision ever made. It's this simple. Risk and reward are two sides of the same coin. They are locked together. If you want the chance to earn a higher return, you absolutely must be willing to take on a higher risk. There are no exceptions to this rule, none. And that's a fair question, right? Why? Why can't there just be a perfect investment out there? Something that's super safe but also pays you a ton of money? Well, the answer has everything to do with how markets and, frankly, how people behave. This is so cool because it shows how the market automatically fixes this. Just imagine for a second that a perfect, low-risk, high-return investment actually did exist. What would happen? Well, everybody would want it. It would be a total feeding frenzy, with investors all competing, trying to outbid each other to get a piece of it. And all that competition, it drives the price up and up and up. But here's the magic part. As the price you pay goes up, your future percentage return automatically goes down. So the competition itself is what eliminates the perfect deal. It pushes that high return back down until it lines up perfectly with its low risk level. The market balances itself. And so that leaves every single investor out there, from a total beginner to a hedge fund billionaire, with the exact same fundamental challenge. See, investing isn't about finding some secret, risk-free treasure map. It's really about looking inside yourself and figuring out your own personal balance point, the balance between how much you want to make and how much you're willing to potentially lose. So in the end, it all comes back to you. From something as simple as splitting a pizza to something as complex as buying a stock, the entire financial world is built on these two big ideas. You get money through either debt or equity, and they're always balancing that trade-off between risk and reward. And all of that leads to one final, very personal question. What's your appetite for risk?